Hey everyone, welcome to our channel. If you're looking to build wealth and make smart investments, you've come to the right place. Today we will be looking at 3 top value stocks to buy right now. Before we begin, don't forget to subscribe to our channel and ring the notification bell so that you are the first to know whenever we release a new video. Now, let's dive in. Let's kick things off with Pfizer, a global pharmaceutical giant that needs no introduction. This company has been a cornerstone in the healthcare industry for decades, making significant contributions to medical science and public health. You know them, you've probably used their products, and their stock has been a steady performer for years. From vaccines to everyday medications, Pfizer's products are ubiquitous and trusted worldwide. But here's the thing right now, Pfizer is looking like a steal. The current market conditions have created a unique opportunity for savvy investors. I'm talking about a potential opportunity to buy a blue chip company at a discounted price. This is the kind of chance that doesn't come around often, especially for a company of Pfizer's caliber. You see, Pfizer has historically traded at a price-to-earnings ratio of around 19. This metric has been a reliable indicator of the company's value over the years. That means, on average, investors have been willing to pay $19 for every $1 of Pfizer's earnings. It's a measure of how much the market values the company's future profitability and growth potential. It's a measure of how much the market values the company's future profitability. This ratio helps investors gauge whether a stock is overvalued or undervalued compared to its earnings. Now get this, Pfizer's forward PE ratio is currently sitting at a much lower number, around 10. This is a significant drop from its historical average, indicating a potential undervaluation. That's almost half its historical average. Such a discrepancy suggests that the market might be missing something or overly pessimistic about Pfizer's future. This suggests that the market might be undervaluing Pfizer's earning potential right now. It's an opportunity for investors to buy into a strong company at a lower price. Why the discount? Well, there are a few factors at play. Market sentiment can be influenced by a variety of elements, and Pfizer is no exception. Like the overall market volatility, which has been a significant factor in recent months, affecting many stocks across various sectors. Concerns about patent cliffs on some of their blockbuster drugs, which could impact future revenue streams if not managed properly, and maybe even some general pessimism in the pharmaceutical sector. This sector often faces scrutiny and regulatory challenges that can affect investor confidence. But here's the thing, Pfizer is a giant, and they have a knack for adapting and innovating. Their history is filled with examples of overcoming challenges and emerging stronger. They've weathered storms before, and they have a massive pipeline of new drugs and therapies in development. This pipeline is crucial for sustaining long-term growth and profitability. Plus, let's not forget about their dividend. This is a key factor for many investors looking for stable income. Pfizer is a dividend aristocrat, meaning they've consistently increased their dividend payments for 25 years straight. This kind of reliability is rare and highly valued. That's the kind of stability and income potential that can make a world of difference in a well-rounded portfolio. It's a cornerstone for those seeking both growth and income. Now, I'm not saying to go all in on Pfizer tomorrow. Every investment decision should be made with careful consideration and due diligence. Remember, investing is a marathon, not a sprint. Patience and strategy are key to long-term success in the stock market. Do your own research, consider your risk tolerance, and all that good stuff. Make sure any investment aligns with your financial goals and risk profile. But at its current price of $29.22 per share, Pfizer is definitely worth a closer look. This could be a golden opportunity to invest in a solid, reliable company at a bargain price. Next up, we're diving into the fascinating world of discount retail with Dollar General. Now, I know what you might be thinking, dollar stores? Really? But there's more to this story than meets the eye. But hear me out, because Dollar General is a different breed. They've quietly become a retail powerhouse, and their stock has a history of outperforming even during economic downturns. This isn't just any dollar store, it's a strategic player in the retail market. Think about it, when times get tough, people start looking for ways to stretch their budgets. They seek value and affordability, and that's where Dollar General steps in. And that's where Dollar General shines. They offer everyday essentials at rock-bottom prices, which is a strategy that tends to resonate even more when people are watching their wallets. From groceries to household items, they cover a wide range of needs. Historically, Dollar General has traded at a P/E ratio of around 20. This indicates strong investor confidence in their business model and consistent performance. That means investors have been willing to pay a premium for their consistent performance and recession-resistant business model. It's a testament to their reliability and strategic planning. But right now, Dollar General's forward P/E ratio is hovering around 13. This lower ratio could be an opportunity for savvy investors. That's a significant discount compared to its historical average, suggesting that the market might be overlooking its long-term potential. So why the discrepancy? What are investors missing? Well, some investors might be worried about inflation squeezing their margins or the potential impact of a slowing economy. These are valid concerns, but there's more to consider. But here's the thing, Dollar General has a knack for navigating these challenges. They're masters of cost control, and they're strategically expanding their store footprint in rural and underserved communities where they face less competition. This expansion strategy is key to their growth. Plus, they're investing in initiatives like DG Fresh, which brings fresh produce and groceries to their stores, further solidifying their position as a one-stop shop for budget-conscious consumers. This initiative is a game changer for their business model. At $81.14 per share, Dollar General is a stock that deserves your attention. It's not just about the price, it's about the value and potential for growth. They've got a proven track record, a recession-resistant business model, and they're trading at a discount compared to their historical valuation. This combination makes Dollar General a compelling investment opportunity. For our final value pick, we're venturing into a sector that's essential for infrastructure and construction, electrical and mechanical products. These products are the backbone of modern infrastructure, ensuring that buildings, data centers, and renewable energy projects are functional and efficient. Meet Atkore Incorporated, a global leader in the production of electrical raceways, cable management systems, and mechanical products. Their extensive product range supports a variety of industries, making them a critical player in the global market. Now, Atkore might not be a household name like Pfizer or Dollar General, but they play a crucial role in the background, literally laying the groundwork for everything from commercial buildings to data centers to renewable energy projects. Their products ensure that these structures are safe, efficient, and up to code. Historically, Atkore has traded at a price-to-earnings ratio of around 13, reflecting the market's recognition of its importance in the construction and infrastructure industries. This ratio indicates a stable and reliable company that investors have trusted over the years. But here's where things get interesting. Atkore's forward price-to-earnings ratio is currently sitting at a compelling 7.7. This lower ratio suggests that the market may be undervaluing the company's future earnings potential. That's significantly lower than its historical average, suggesting a potential undervaluation by the market. This could be an opportunity for savvy investors to buy into a strong company at a discounted price. So why is Atkore trading at such a discount? What factors are contributing to this lower valuation? Well, some investors might be concerned about the cyclical nature of the construction industry and the potential impact of rising interest rates on building projects. These concerns can lead to short-term volatility in the stock price. However, here's the thing. Atkore is well positioned to weather these challenges. Their diverse product range and strong market presence provide a buffer against industry fluctuations. They have a diversified product portfolio, a strong track record of profitability, and they're benefiting from several tailwinds in the market. These factors contribute to their resilience and long-term growth potential. Think about it. The government's focus on infrastructure spending, which is expected to increase significantly in the coming years, the ongoing growth of data centers and cloud computing, which require extensive electrical and mechanical infrastructure, and the increasing demand for renewable energy solutions all play right into Atkore's strengths. These sectors are poised for substantial growth, providing Atkore with numerous opportunities. At $89.43 per share, Atkore represents a compelling opportunity for value investors. This price point offers a chance to invest in a company with strong fundamentals at a bargain. They're a leader in a vital industry, they're poised to benefit from long-term growth trends, and they're trading at a significant discount to their historical valuation. For investors looking for a solid, undervalued stock with growth potential, Atkore is worth considering. So there you have it, 3 top value stocks that could potentially supercharge your portfolio. Remember, these are just starting points for your own research. Always do your due diligence, consider your risk tolerance, and consult with a financial advisor if needed. Investing involves risk, and past performance is not indicative of future results. If you liked this video and found it helpful, we think that you will also like the 2 videos now appearing on the screen. Go ahead and click on one of them now to continue your financial and investment journey. Thanks for watching. We'll see you in the next video.